I think TradFi can be pretty complex. However, there's less value add there that you can deliver, and it's overanalyzed and researched, and the risks are kind of well known at this point. Crypto is just the exact opposite, so it's harder.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show.
Marcos, thank you so much for joining me today. Super excited to chat with you. All right, Marcos, you are a partner at Accolade Partners, which is a venture capital and growth equity fund of funds. You guys also participate in co-investments and secondaries. The firm was founded in 2000, and you guys now manage over 6 billion AUM, which is just, amazing. You've invested in over 20 Web3 funds, and also you guys invest in traditional funds such as Thoma Bravo, A16Z, Excel, Kleiner, etc., other top amazing funds. Very, very excited to have you on, and really excited to dive deep into the kind of crypto fund-to-fund investing side. But to kick it off, how did you start, becoming involved or interested in crypto? Because everyone always has some kind of interesting, unusual journey. So can you tell me about that initial, what initially piqued your interest to dive deeper into the crypto world?
Of course, Andrew. First of all, thank you for having me. It's a pleasure. I mean, we've known each other for years at this point, like since the early days. And I'm excited to join you on this and cover, and everything related to what us allocators are doing. But how did I start? So I'm Greek, as many people know. I'm Greek, and it wasn't in Greece physically during the crisis that happened, but my mom was there, my family was there. And the country went through, severe crisis that included capital controls. And I recall, I was living in London at the time, even taking some cash out from ATMs in London and taking the cash over to my mom in Greece because she could only take a max amount out of cash.
And sorry, you were physically traveling to Greece to send the money?
I didn't do it I didn't travel just to give her the money.
Yeah,
but
no, of course.
While I was going back, I often took money with me during that period of time to give her cash because she couldn't take more than a certain amount of cash out from the ATMs.
You bringing local Greek currency, or were you bringing pounds?
Euros. I exchanged pounds to euros. Greece had the euro, and I remember doing that, and I was like, "Are we in 2015 really? Like, I have to bring cash back to my mom from England." In any case, so then I realized that if this could happen to a EU member state, like just imagine other places in the world. And at the same time, I started reading about Bitcoin. And immediately the idea of Bitcoin was evident to me, right? It was an asset that is digital, peer-to-peer. You control it, or you can control it if you don't custody it in Coinbase or somewhere else. You can actually custody it yourself with your private keys, etc. It's not subject to capital controls. It's not subject to seizure. It was an eye-opening moment for me. And I think it was really related to that moment in time that I was living through, which was surreal in a way. So I think that's when it caught my attention and it piqued my interest personally, right? And then I started reading about it. I read this book called Mastering Bitcoin that a friend of mine suggested. The Greek guy called Andreas Antonopoulos has written. So it's a great book. Like, I'm not a programmer, and the book can be quite technical, but I read the text and I took my time to read it, and I just found it fascinating, the whole Bitcoin network, how it functioned and how it managed to solve the problem of double spending and all of that. So I was fascinated by it also from a innovation perspective as well after I started reading about it. So that's how it started. And then obviously, like, it entered my professional life in early 2018 when I was at Cambridge Associates. We can go back in time, and I started kind of officially like researching the crypto blockchain space. from a professional perspective at that point.
And going back to when you first were digging into Bitcoin, were you researching Bitcoin because you were curious, how can I send my family money more effectively? Or was it some other random happenstance that where you started digging into what Bitcoin is?
It was kind of a random happenstance. Somebody mentioned it to me. I started reading, focusing more. I mean, people had mentioned it to me before, but I started um, kind of focusing my attention to it more and reading about it. I realized it was peer-to-peer. So I would say like the circumstances led me to revisit kind of Bitcoin and actually give it a look. And then I realized, what an incredible innovation it was in my view. For the first time to have a peer-to-peer digital asset, borderless, global, not instantly exactly, but almost instantly settled. Like, I mean, it's if people don't understand that, then I mean, there's not much else I can tell them why this is an important or very interesting innovation.
And so 2018, Cambridge Associates, could you give a brief explainer of Cambridge Associates? I mean, my very basic understanding is that they're a extremely large asset manager and they are involved in all types of activities. I think, they fund of funds. I think they do asset management, maybe SMAs. But what is like the kind of the broad overview of Cambridge? Because they're a behemoth.
So I joined Cambridge after business school. So I went to business school in New York. I came to the States and went to business school in New York. And then, like a business school graduate, I found a job and I actually stayed in the States for my first 7 years at Cambridge Associates. I found a job there through business school, and I ended up spending 13 and a half years there across 3 different offices, 7 in Boston, 4 in London, and then back in the States in DC, where I'm at right now. The firm is a legendary firm in the sense that it started out in the 70s and around the time when Yale was also pioneering the endowment, what's called the endowment model, basically equity-heavy portfolios with a high dosage of alternatives, hedge funds, private equity, venture capital, etc., which now it seems, evident, but back then, not many institutions were employing this tactic. And so Cambridge was one of the pioneers of that approach, and it started advising endowments in the US and on asset allocation, but also on selecting the actual managers in each of these categories. And by the time I joined, it was the largest consulting firm, investment consulting firm in the US specifically for endowments and foundations. By the time I left, it had evolved to also managing directly some of these endowments, what's called the OCIO business, which is outsourced chief investment officer business. But overall, like asset allocation and manager selection, very, very similar to what I do now, which is a fund of funds approach, right? But Cambridge was more of an advisory firm.
And so do you bring the theses and ideas pertaining to crypto to Cambridge, or was there already a group within the firm that was talking about and excited about crypto?
I think there was a group. I mean, it was, remember 2017 ICO bubble, and everybody was talking about that. There was a group that was seriously talking about crypto at Cambridge. However, we didn't have a centralized effort, meaning we didn't have a point person to gather the data, research things further, disseminate, the information, find the managers, all of that. So it was some people were doing it, but I raised my hand to do it in a dedicated way, at least part-time, because I had other responsibilities and crypto wasn't big enough at the time. And the reason I raised my hand to do this is because I was just already fascinated personally by crypto.
Were you known as like because oftentimes I hear stories about people being kind of the one who's championing crypto at their firm, and people view them as kind of like, oh, it's Marcos. He's like into the weird crypto stuff. What was the perception of crypto at Cambridge at the time? Was it like, this is a funny, weird thing that we should kind of look into, or is like, oh, this is the future, or what was that? What was that perception?
I mean, it was mixed depending on the person, right, and their level of knowledge. But I would say like that the firm in general was a first mover in the space. So the fact that the firm was willing to explore this space as early as, remember, like January 2018, nobody was exploring the space on the allocator side. The fact that the firm was willing to do that shows like a DNA of being innovative and trying to find things early on, like it was back in the 70s when venture capital was a nascent thing, right? It's kind of the same DNA, like you try and look at things early. So I think there was a substantial group of people who were intrigued by it, but I mean the majority, I would say, was very skeptical of it, right? I mean, it hadn't shown yet any real use case. People had lost a lot of money in the ICO bubble. It wasn't institutional, right? So I do think the vast majority were skeptics at the time. But I would say there were also several clients, institutions that were interested in looking at it. You would consider them from the outside as to be conservative institutions, but actually they were interested in looking at it.
And that was in, you moved over to Accolade, which is where you are today. And that was, hey, Marcos, we need someone full-time just to be focused on the crypto ecosystem. Because as you said, it's growing rapidly and it's very expansive. Is that right?
Exactly. I mean, crypto took off in 2021, and it took off in a way that I don't think anyone expected it. Certainly, I didn't expect. So what do I mean by that? In 2020, there was some allocation happening from institutions to crypto, but it was pretty muted, right? There was these first mover institutions that were open-minded about it that were doing it. And it was a pretty niche area. Like I could count on 5 fingers the people allocating to crypto. Like it was myself, Brooke Pollack, Accolade, Andrew Chen, a few others. But in 2021, the space took off and the influx of capital was overwhelming. It just came in kind of second half of 2021. There were so many allocators who wanted to do that. So it was clear that from that moment on, this would be a space where there would be significant institutional participation. And it was an inflection point. I also live in DC, so Accolade is in DC, so it was a perfect match. I knew the guys also very well from my days at Cambridge. We were sharing ideas as early as January 2018 about the space.
So that was, okay, early days, 2020, 2021. How were you going about sourcing these early managers in the crypto ecosystem? Because, that there weren't, now there's, I don't even know how many, you probably know. But it seems like back then there weren't that many, especially in 2020, early 21. I'm sure in 2022, there was a significant boost, but how did you go about around sourcing these different managers at that time?
Yeah, so I went to conferences. I remember I started, probably early 2018 to going to several conferences and starting to meet people. I started reading. I remember reading, what the multi-coin guys were writing, for example. I started, reaching out to people, connecting the dots. If you do that for 3-4 weeks, after a point in time, you start connecting the dots and getting in touch with people, and you move from one thing to the next. Eventually, I had met, I think, most good managers of the times, meaning, met during that period, met Dragonfly, Multicoin, Electric, met Andreessen Horowitz, obviously launched their fund then. I mean, there were many funds that are well known today that emerged, around that time. But it was more about like doing a bit of grassroots research, right? Like going to conferences, reaching out to people cold, reading their stuff, getting introductions, that sort of thing.
Very cool. Yeah. And these early days, determining who's actually good is extremely, it's always hard to determine who's good, but in the early days with so little data to go off of, how would you make that determination? And this is, 2020, 2021. Would it be more so, having conversations with them and understanding their knowledge base of certain technical aspects of crypto blockchain and their thoughts and theses, or how are you making that assessment of how well they might perform?
Yeah, it was a very difficult thing to do, as you say, because I mean, many of these folks didn't have official track records, or they had some angel investments maybe, or small investments. And, if they had a track record, it wasn't very long. And in traditional finance, you're used to long track records. So it's the quantitative aspect is part of your analysis. Here, like you had to take that out of the picture and you had to say, hey, this is a completely new area. These guys are first movers. What's their reputation? Like, how do entrepreneurs feel about them? So I spoke with many entrepreneurs at the time to get a sense of like who they valued, who they didn't. And I think that was the primary data point, if you will, or the primary set of data points that guided my my diligence at the time.
I mean, yeah, that makes total sense. And it's, references and kind of the people that are actually getting the funding. It's they're going to tell you the truth. They have no reason to kind of lie there. So that's a very smart idea. And do you think that during this process and still today, you have developed a great ability to read folks, or how are you able to, references is one thing, you have to find the incentives to make sure the references aren't incentivized to lie, right? Not that people are outwardly lying, just, you want to make sure as you get to the source of truth as quickly as possible. But yeah, how was your personal ability to read people evolved over the years?
That's a great question, and there's no easy answer there because I can give you some high level thoughts, but at the end of the day, it's something you learn and you get better at, I think, and you're never like perfect, but you get better at it, and I think it's less a theory, more a practice. That's why it's a little bit harder to explain exactly how you make these determinations. But I would say, what are the most important traits, right? I think number one, like integrity, right? That a person has integrity. Number two, passion. I think, if somebody has a passion, they will be there and deliver the maximum. And they will also be there for the long term, most likely. Intelligence, obviously, right? Like if you speak with somebody and you talk about specifics, you can understand like their level of depth, how much work they've done. You quickly kind of connect the dots on, through other interactions you've had with people, you can start kind of benchmarking things as well. So I think these were some of the most important characteristics. To me, like for crypto, there's also another one, which is resilience. And I think it's extraordinarily important in crypto because with the viciousness of these cycles, if you're not resilient, you're going to drop off. I mean, 100%. Like in a bear market, you're going to drop off. It takes a strong stomach. I don't need to tell you that, but by the way, like you know it very well. But I think understanding also whether that person will be there when times look bad is key, and whether that person will be making investments during times where things are bad.
In terms of managers meeting you and you getting comfortable with folks, because a lot of crypto is remote even before even before COVID and whatnot. But are you seeing these managers at multiple conferences and you're having conversations with them? Is that continuous exposure? Like let's say I'm a manager, I'm trying to raise from Accolade. The best way is obviously have good performance, of course, and have the following traits that you mentioned in addition to that good performance. But should I try to attend as many conferences as possible and talk with the right folks so they have that repeated exposure or continuous exposure to me, so I'm not some stranger? And they kind of, over 5, 6, 7, 8 meetings, they're like, okay, Marcos has a rough idea of who I am and he can read my thoughts and theses and whatnot. Is that kind of something that, managers should be thinking about, or is that continuous in-person exposure not as important because we're in a kind of virtual, environment?
I think in person to me is important. Like you don't have to do it like 8 times, but I think you got to do it a few times, right? And of course Zoom exposure. I mean there are hundreds of crypto venture funds at this point. Like I think we've met over 500, and yeah, believe it or not, that includes some open-ended types of strategies. So liquid venture. I'm not including things like arbitrage or long short like crypto strategies, and I'm talking more about venture long only kind of exposures, including open end. So there's a lot going on, and so I mean, obviously, like we try to meet everyone and we try to take notes on everyone and be familiar with what is going on. But sometimes, having more interactions on the part of a manager helps with awareness of what they're doing. And so I would encourage it.
So yeah, talking about the liquid versus kind of venture strategy, what do you guys focus on at Accolade? Because you also mentioned that, it could be a crypto venture fund, but once those tokens go live, it's kind of akin to a hedge fund, or can be. So tell me about your, Accolade's focus and that kind of weird crossover between liquid and VC and crypto.
Yeah, we do both. Actually, strategies like the venture side, which is as closed-ended structures, and the open-ended side, which is kind of hedge fund structures. And I'd say, like, in some cases, the two are absolutely similar. Like if you look at the two portfolios and you don't know whether it's open-ended or closed-ended, and you look at the positions, in some cases you couldn't tell the difference, right? And one fund is open-end and the other is closed-end. I think, though, in general, like the closed-ended strategies have a little bit more early-stage pre-token launch exposure, certainly at the beginning. And then the open-end funds have obviously at upfront a lot of liquid exposure and then build illiquid exposure, earlier stage exposure over time via side pockets. If you fast forward in time, they're both a healthy mix of tokens and early stage stuff, right? Now, what is better or what is the appropriate structure? That's a very hard question. I think it depends. I think I used to like the venture structure back in the 18-19 period a lot because it was a long-term type of structure, right? And you knew that managers weren't going to be forced sellers. They could play the cycles, etc. Since then, I've seen some open-ended managers navigate things really well also in terms of cycles. But I would say in our mind, both fit like the venture capital long-term, like betting on this sector mindset. This space is tokens and equity. And it will always be like that.
All right. So if we were hypothetical, Marcos, you have $1 billion family office and you could only invest in either liquid crypto funds or crypto venture funds, what would you choose?
I would probably choose venture funds. The reason being that I have like a 10-year time horizon at least, right? So I don't need to take any money out after 3 years. Now, I don't have to, even if it's an open-ended fund. But the thing that worries me a little more about open-ended funds, and again, they're not all equal, just to be clear, is that people can actually take money out and they can face some pressures during a bear market. So other things being equal, the venture funds are more protected from that. And I think staying alive in the bear market is like half the battle, if not more than that, like 80% of the battle. So I'd probably go for venture structures. Again, I don't want to be too rigid in my thinking. In fact, I would do both. But if I had to choose, probably the venture structures.
What is, maybe this is not the correct question, but is there a overarching investment philosophy with Accolade pertaining to crypto? Or, is it because it's such a new emerging market in space that there's not one kind of strict thesis? It's more like, hey, we want to make bets in this market because we're very bullish on it, and different managers are doing a huge range of strategies.
The thesis is that this is a major open source software innovation. It is the internet of value. It complements the internet of information. It feels like a really natural part of the evolution of the internet. That's thesis number one. Thesis number two is like many people misunderstand it or are too scared to tackle it. So we can be the ones who can tackle it and figure it out and diligence it and make sense of it and make good investments in it for the long term. So I think we have a strong conviction in the space on the one hand. We also think that it's a great space to actually add value from where we stand for investors, because it just is an area that is difficult. It's difficult to research, difficult to understand, difficult to manage. And we want to play that role, and we are playing that role for the past several years.
Yeah. So crypto is extremely complex. But TradFi for me is extremely complex, right? And so from your perspective, because you were in both worlds, would you say that TradFi is just as complex as crypto? Or do you think that no, truly crypto has a lot of intricacies that really you just got to have a lot of experience and time in the market to really get to understand? Because from my opinion, it just seems like, oh, TradFi is just like that. Is exactly the same.
The TradFi can be complex. I mean, there are countless of strategies, like can be challenging to understand, like all different like trading strategies or hedge fund strategies or products, etc. However, it's been around for a very long time. You kind of know its risk characteristics more or less. There's so much that has been written about it, like it's covered by thousands of analysts and people. Honestly, like there's not much value to add over there. Like as if from an allocator perspective, one of the reasons also that attracted me, I didn't mention that before, to crypto was like, okay, here I can actually make a difference, right? Like I'm not going to make a difference in hedge fund land. Like, I mean, it's been analyzed for 40 years and there've been like thousands of books and articles, millions of articles published. And like, I might add some value, but it's going to be marginal. I think crypto is much harder, in my opinion, to navigate. And it's much harder because there's much less information around it. It's not regulated, at least so far. It has immense volatility, which people panic with the volatility of the S&P 500. Like investors really have a rough time, when there's a lot of volatility in the S&P 500. Just imagine here. Like it's very hard. It's very hard to stay the course. It's very hard to manage that, the feelings around that, the investment strategies around that. So to answer your question, maybe to summarize, like I think TradFi can be pretty complex. However, there's less value add there that you can deliver, and it's overanalyzed and researched, and the risks are kind of well known at this point. Crypto is just the exact opposite. So it's harder.
So when you're thinking about portfolio allocation with Accolade, are you guys thinking about, okay, we have 5 venture funds, we should probably have 5 liquid funds, and we have most of our funds are in America, so we should go to Asia and find some more funds? Or are you guys setting out strict guidelines as to kind of filling in these specific criteria that you're targeting? Or is it more, hey, crypto's pretty new, so we don't want to kind of lock ourselves into a structure that we might not like?
Yeah, I think we're very open-minded. In general, we take an approach where is diversified in the sense that like we do a lot of early stage investing, and we love early stage investing, meaning pre-seed, early seed, small funds. We think you really kind of have really outsized returns if you get it right. So we love doing that, but we also do funds that have more liquid token exposure as well, right? I think this is not a space where at this stage you should be taking too many kind of thematic bets. I think you pick managers that you like and you let them run. With all of that said, we've done some things like specialists, right? In gaming, Web3 gaming, consumer, Europe, Asia. We've done some of that, but in general, I think it's been more kind of generalist type of funds, both early stage and later stage, both closed end and open end. So I really don't think there's a recipe yet here of success. I mean, you can find it in many places.
When you're looking at and speaking to different managers, what are, and you did mention those traits earlier, but what are some other qualitative traits you look for? Obviously managers should have a really in-depth knowledge about their specific area of expertise and whatnot. But what are some other, qualitative metrics or qualitative things that you look at when speaking to managers?
I think depth, passion, resilience are the 3 most important things. Now, you don't want somebody who doesn't change their mind, right? But you want somebody who believes in the space long term. Somebody who from the outset tells you and knows that this space is going to go through really bad times. And I cannot stress that enough. I strongly believe, having studied the space and other technological events, that the only way, the most rational way to play the space, if it works, let's assume it works or it doesn't work, but either way, the way to play it is to be investing throughout the cycles. That's the only way for success. So if somebody's going to bail, after the first piece of bad news, they're not going to persist, their next fundraise is tough and they're going to wrap up and leave, that's not the type of manager we're looking for, right? I think you need people with resilience here. And passion creates resilience, right? If you're passionate about something, you're most likely to be more resilient when the times are bad, because passion is going to drive you through that. So I think these are the three characteristics in my mind, like the main ones.
Yeah, and also you spoke about kind of the specialization. You like to target funds that are not necessarily specialized, but you have also done a few funds that are specialized in certain areas. But we're talking about resilience, and from my experience, the crypto ecosystem has every kind of cycle has these certain sub-markets that outperform. 2019, 2020, DeFi, 21 NFT, so on and so forth, et cetera. I guess you could argue like 24 and today it's like meme coins and AI coins maybe, which are kind of similar. But these managers and having this resilience, have you found that the managers that can say, hey, maybe I start off in DeFi, but now I'm going on to gaming, and kind of be able to ride these narratives, have you found that to be effective? Or really the manager that started with DeFi has a really tough time entering and kind of investing in different areas of the market?
No, I think our experience has been most managers have actually managed to evolve around themes, right? They know the space well. They understand the power of blockchains in general, like across verticals. And we've seen managers that were originally like only DeFi focused, right? Now they're doing DePIN, for example, as well, and they're doing that effectively. So I think our experience has been that managers have successfully kind of pivoted, if you will, or moved into different areas in the blockchain space, at least the ones we work with, because this space is also like going to move like up and down, and also like in different categories are going to emerge, other categories are going to go silent. Like this is the nature of this game.
Yeah, you said up and down. I was thinking up and down, left, right, behind you. It's just like, evolving in multiple dimensions there. But so okay, when you're looking at different managers, what have you identified to be a kind of a source of sustainable edge?
We do a lot of referencing or with entrepreneurs, and we do a lot of that as part of our process. And I think managers who reference really well with entrepreneurs tend to do well. However, that's not the only thing. The other thing is also portfolio construction, I think. To give you an example, like let's take a venture fund, because open-end funds are a little different. Like let's take an early stage venture fund. It's the same with traditional venture, by the way. Like the big outcomes happen when you have high ownership in something, right? And your fund size is a certain size that's not too large, right? So this ratio of ownership on fund size can determine, whether an outcome is going to be massive or medium or small. So I think managers who take high conviction bets, like they have a portfolio of like several companies. Of course, you need to be diversified, but are taking pretty high conviction bets and are taking substantial ownership and are keeping the fund size relatively small, I think is important. So it's references, of course, like getting access to the best deals, but also the portfolio construction is important. On the liquid side, I think managers there, there are all sorts of flavors there on the liquid side, but I think managers who will buy liquid assets during a bear market, including venture managers, historically they've done really well, right? And either calling capital to buy liquid assets in a bear market, or if they're a kind of an open-ended type of fund, maybe de-risking a little bit in a bull market, holding a little bit more cash when things are overheated, and maybe investing a little bit more cash into the market when things are actually very depressed. It's easier said than done, by the way, but it makes a huge difference.
Totally. Yeah, no, it is exceptionally to have the confidence to call capital during a bear market and deploy that capital and in size into liquid tokens is extremely, you have to have very, very high conviction and, be ready for that, because it often, it gets pretty volatile during bear markets. It's volatile all the time, but, it takes a lot of confidence there. So you mentioned the fund sizes. In terms of what would you consider to be too large of a fund size for venture, and then too large of a fund size for liquid, or maybe it's the same?
It's all very dependent. Like for venture, I mean, if you're trying to do pre-seed seed, like I don't think you should be more than $100 million, right? Probably less. If you want to have a bucket for large series A's and liquid tokens, then you can have a much larger fund size. But I would say if you really want to do pre-seed seed, it should be 100 and lower, in my opinion. We can argue whether it's 190, 110 or whatever. I'm giving you like a rough number. On the liquid side, like, listen, if you have a strategy that buys Bitcoin and ETH, you can run billions of dollars. But if you want to be a token picker of small cap tokens, right? And you want to buy things that have very thin volume, you need to adjust your fund size so that your market impact when buying or selling is minimal, and you can actually exit and enter positions at a certain size, like over a period of several days. So I guess the short answer is, it depends. What you shouldn't do is like have a strategy that doesn't match the asset size, right? Like, and we see many managers doing that. Actually, they grow and grow and grow, and they used to be great at doing early stage investing. Now they're doing late stage investing. They used to be great at picking like small cap tokens. Now they're buying SOL. Like, you just need to make sure that that your skill set and your asset base are matched.
That makes total sense. So in your experience, have you identified correlates of success between the funds that you're investing in? And maybe it's like the timing. So it's like, hey, these vintages tend to really crush it. Or, if you have incredible access, then these funds that have great access always tend to outperform. Or have you found these correlates of success, or is it pretty manager dependent still?
I think it's quite manager dependent, but also like, I think these are certainly aspects of success, right? To give you an example, timing, right? I mean, anyone who invested in 2018 the returns vary, but if you look at those vintages back then, they've, almost every manager of that vintage that I know of, like, has done so much better than the top 10% of traditional venture, right? So timing, it was amazing timing, amazing vintage, bear market, low valuations, less competition, all of that stuff. These things matter. Differently, like in 2021, it was not a great timing. Like you had high valuations, tons of capital, tons of competition. So timing matters a ton. And I'm not sure managers actually, they can try to they can try to manage the timing to a certain extent, but not to a full extent, as you know, right? But they can try. On the other hand, access, I think, matters, right? I think, crypto has gone up like as a category a lot, but if you had picked certain deals and had gotten into certain deals where entrepreneurs were high quality, like you could have really outsized returns. Like I'm thinking of companies like back from 2018, like Bison Trails, for example, right? Which I know it was a bit access constrained from what I recall, but that if you had access in size, something like that with great entrepreneurs, like you could really shine. So the short answer, Andrew, is like a little bit of everything.
Yeah, I think that I wonder if we're going to see it evolve in the future where it does become, maybe it's always been like that, even in TradFi, where the short answer is that it actually depends. But maybe with crypto, it kind of coalesces towards timing or coalesces towards, access or whatever. But I expect it to probably not be like that. I expect it to just broaden and become more really manager dependent and their specific skill set and their team skill set. But so talking about, kind of TradFi versus crypto, what are your views on crypto exposure versus, or like token exposure versus equity? Do you like to have a little bit of a mixture? Do you like token mostly, equity mostly? What are your views there?
I think the way things have evolved, where you have like equity in a business plus the token warrants, like is a perfect world, right? You have exposure to both, like wherever the value accrues, and you can accrue value in both potentially, right? I do think though that the major innovation here is tokens, and I do want to see tokens, right? If investing in crypto, like I think it's part of the greatness of crypto is like that you can have early liquidity, you can trade early stage projects, early on without having to wait like 15 years to IPO or something. So that's the positive side. Of course, the negative side is there's a ton of speculation, ups and downs, terrible projects get overvalued and all of that. So the game you're playing is so much different than a traditional VC. But would like to have a foot in both and certainly have the token element.
Totally. You can be as big as you want here, but can you give an example of a great investment that you guys have made at Accolade?
I think for crypto, this is the case for all asset classes, I believe, but for crypto even more so. I mean, we bought many secondary investments, meaning LP interest in the secondary markets during the bear market. And I think those are going to be extraordinary investments. Why? Because twofold. Number one, prices are down in a bear market. Like there are always tokens in some of these interests, they're down a lot. So you're buying like these tokens at a very cheap price. You're also buying these interests at a very steep discount because the investors really want to get rid of it. They're either forced sellers or they lost confidence in the asset class. So there's this natural arbitrage from long-term believers, holders, and short-term holders and people who don't really believe in it. And you can basically have these extraordinary pricing opportunities to buy assets kind of at the very bottom. I first came across this with Mt. Gox. The claims, you're familiar with it. Just to be clear, this is not an Accolade trade. I'm referring to a Mt. Gox that happened in 2014, and then there was a bankruptcy. People were selling their claims of the estate. That was a situation where, if you had bought some of these distressed claims early on, it would have been one of the most extraordinary trades ever. It's both the distressed aspect and the crypto cyclicality. Like the two together are a very powerful combination.
Yeah, were those claims, did they get Bitcoin as well as the equity of the company?
Yeah, so it was only basically it was claims that the underlying estate of Mt. Gox had cash, they had Bitcoins, and they had Bitcoin Cash. So it was such a simple trade, like in the sense that you could buy one claim, for example, right, for $100, let's say, right? And there was a point in time where you bought one claim for $100, and in that claim, there was like $85 of cash, Bitcoin and Bitcoin Cash. So basically, if Bitcoin went to zero, you got 85% of your money back. If Bitcoin kept appreciating, you got kind of leveraged upside on Bitcoin. And so you were basically getting leveraged upside on Bitcoin with downside protection. I mean, it's an incredible trade. And the reason that happened is that people who owned these claims needed liquidity, or they weren't willing to wait, or they didn't understand the bankruptcy process, or countless reasons.
Yeah, it's I was listening to a podcast recently and someone had said the best trade is when you're a forced holder of crypto, and they said, and specifically Bitcoin, and they said that Ross Ulbricht is like one of the best investors because he created the Silk Road, which is that drug marketplace. He got arrested, put in jail for what was supposed to be life, and he had a lot of Bitcoin. And his sentence was just he was just pardoned by Trump recently, and so now he's out and he has apparently access to some Bitcoin that has appreciated massively. So everyone, people are saying that, yeah, if you were in that position and you were free and had access to your Bitcoin, you would probably sell after X% increase. Wow, it's gone up 5,000%. I'm going to sell, right? Because it's logical. But as a forced holder, like anyways, so that reminded me of.
Oh, there's certainly an aspect there with this Mt. Gox trade, right? Like, the person who's willing to hold for the long term and is not trying to get liquidity right now, is gonna reap the benefits, right, of the trade. There's always a risk, right? The risk was that Bitcoin would go to zero and you'd get a certain percentage of your money back. But the incredible thing with Mount Gox was that there was a ton of cash in the estate also, and depending on the price you bought the claims, like you also had this natural like downside protection, like you were buying like a pool of cash, Bitcoin cash, for a very cheap price. We went down the rabbit hole of Mount Gox, but that's one of my favorite like distressed trades of all time.
Love that. All right. So speaking of a distressed trade, have you been involved in any sort of like very difficult situations at Accolade, or any sort of like quote unquote crucible moments that were very difficult? And then if so, what lessons did you take away after you overcame that obstacle?
Yeah, I mean, the bear market can be very difficult on managers. It can be very difficult on entrepreneurs. It can be very difficult on investors. And I think a crypto bear market is like 10x like a normal bear market in that respect. And I just think that you need to keep a level head and be calm and take a long-term perspective and try to navigate that period until you're out of it, because you will likely get out of it at some point. So I don't have like specific examples around that, but I would say in general, the bear market can be challenging for everyone involved in the space. So the most important thing is to not panic, I think, be calm, play for the long term.
All right. So I'm always interested in service providers, because service providers in this world of crypto are pretty unique. Well, their capabilities are unique. Oftentimes, they're traditional providers that now have implemented crypto systems and whatnot. But if you could wave a magic wand and kind of change some operational aspect of kind of fund operations, whether it be tax, audit, fund admin, whatever, custody, how would you, that magic wand could improve something, some operational aspect? What would you choose to improve?
Yeah, that's a great question. I think custody would have been something I would have mentioned like a few years back, but I think now it's improved a ton. There's still like stuff to do there, but I think with all these custody offerings and the way things have evolved, like it's much more professional now. When I look at funds, like especially on the open-ended side, valuations, like the way people value things, can be a little bit inconsistent. Like, I mean, with respect to locked tokens, things like that, right? So it can be a little frustrating if different managers use different types of methodologies to kind of compare and contrast them. And you often need to dig deeper and kind of look at the valuation policies and all that. I think it would be great if there was like one standard that the industry adopted eventually, like on valuation policy. Maybe that.
So, next question, what would be that if you could design the standard? You're saying, hey, Marcos, we need to design the golden standard for valuation policies for valuing these assets, especially locked tokens. How would that look?
Definitely have a discount. Because recently there was this ASU proposal. In any case, like certain managers use this ASU guidance to maybe consider, not discounting any of the locked tokens. And I think that would make their portfolio so much more volatile, right? And also, like, I don't think a token that has a low float and high FDV, it could end up overcoming its valuation, over time, like if it's the next Solana or whatever. But like the vast majority of these are probably going to trade substantially lower than that at the end of the day when things unlock. So I would definitely have a discount. I mean, one natural one is using a Black-Scholes model. Like, I think many managers do that. I think that makes sense. So it would just be nice if all managers had the same methodology, so you knew like that without having to dig deeper every time, you knew that you're comparing and contrasting two similar things.
Totally. Yeah, no, it is tough though. It's like, what's a fair discount? Is it 20%? Is it 50%? 80%? In different scenarios, there's, maybe you can come up with different logic as to why you gave that specific discount. But yeah, no, I think a standard would be great. Okay, so the fundraising environment, a lot of people, a lot of people have been saying the institutions are coming since like 21 and maybe even since, 18, where like enterprise blockchain was a kind of a big theme. But so are the institutions coming from your standpoint, and especially with kind of the new administration who's more pro crypto, obviously with Trump, our president launching a meme coin, which is insane. And now Bitcoin's reached 100. Well, it's going back around, hovering around 100K. Have you noticed a appetite change in terms of institutional awareness and interest in crypto?
Yes, I think there's a lag, right? The elections happened in November, and now we're January. We're not even in February yet, so there's definitely going to be a lag. But I do feel that the environment is going to be much more positive for fundraising than it was like the past couple of years post FTX. For two reasons. One is that all these frauds happened, in a very short period of time, and FTX was an absolute shock to the system as well. And it happened after several other frauds and bankruptcies had occurred. So institutional investors were just like spooked at that point and left. And then you also had the SEC campaign against crypto, which gave it a generally a regulatory risk component that many people found to be too risky for their mandates. Now, the frauds, all these things have kind of washed out. It's been several years at this point. I don't think there's any other shoe to drop right now. Like, I think we've seen them all, at least from the past vintages. Like, I think they're gone. So you have that. And so people have moved on from that. And number two, like, it looks like with this administration, the space is gonna have regulatory clarity. And in any case, there's been a massive regulatory de-risking of the space, given this new administration. And so I think these two things combined is going to bring back institutions to the space. And I think is it going to be like 2021? I don't know. I don't think so. I think there was just so much interest back then that I'm not sure we're going to see it again to that extent in such a short period of time. But I do think it's going to be much better this year.
Awesome. All right, Marco, so you ready for the closing questions?
Yes.
Alrighty. What trend in crypto do you think is overhyped, and which trend do you think is underhyped?
Yeah. And just to be clear, I believe in everything crypto, and they will go through periods. But I think you mentioned meme coins, AI, etc. I feel these are overhyped areas right now. Will they exist in the future? Of course, they will exist. But meme coins kind of feel like NFT mania to me, like right now. Maybe it's going to go even higher. I don't know. But I do feel they're a little bit overhyped. That doesn't mean that they're areas that are not going to exist in the future, right? I think that's kind of more the overhyped part. The underhyped, I think there are just so many protocols out there generating income, cash, etc., and are sitting at pretty low multiples. Like, and you wonder, they're not the new flashy narrative, and they just seem undervalued at this point. And some DeFi protocols, for example, and you can see the potential for these to re-rate, in the next several months.
To speculate a little bit, could you see a future, maybe this year or next 4 years or whatnot, where these tokens can send the revenues back to token holders?
I believe so, like with this new administration, right? Because there's going to be some sort of regulatory clarity. And I do believe that there's going to be also a constructive regulatory framework, the way things are developing, which will allow some of these projects to return the money back to investors. Like, I think they've been withholding that for fear of being targeted by the SEC. But now that fear is not there anymore.
Yeah, it's tough to be super fearful after the president launches a meme coin. You're like, all right, well, it seems like we can probably try this, Not saying do it. I'm just saying, it seems like it's open season. Cool. All right. What is a lesson that you've learned recently that's surprised you?
The life lesson, for example.
Yeah, that'd be great.
So I'll talk about my kids. I have 2 daughters, right? They're young. Before I had kids, I thought that were kids and they didn't know much and they didn't understand the world much. And I've seen by speaking to my daughter sometimes that they can actually see things better than I can in certain circumstances. Like just by thinking simple and by not overcomplicating things and by actually seeing through the essence of things. Like I've seen my daughter, who's like 7 years old, like tell me something that I'm then thinking, how could I have not thought about that? For example, she told me the other day, Daddy, you look too stressed. You're always on your computer. The world is beautiful out there and you can go out and have fun, that sort of thing. And it's a very simple message, but it's something that an element of wisdom around it that my 7-year-old was able to get, and I wasn't able to get.
It's so true. It's absolutely, I was smiling because I'm like, man, I have a 3-year-old son, and he, I forget what he said recently, but he said something recently, and he's 3 years old. So he just, he's learning how to speak and whatnot. But, it just cut straight to the truth of what the situation was. And I was so surprised by it. I was like, oh my gosh, like he just like taught me something, or told me something that's so truthful. Exactly as your daughter said, hey, you're on your computer too much, let's go outside, let's go take a walk, So man, that's totally accurate. I love that. All right. If you could go back in time and give your younger self one piece of investment advice, what would that advice be?
You can take more risk than you think.
Interesting. Okay. Interesting. Do you think that within your personal investing that you've been more defensive?
I think that before I found crypto, I was a little bit conservative. And I was more focused on capital preservation rather than capital appreciation. And I don't think I should have been. I think if you have a long-term time horizon, you can take more risk. Now, I don't want, this is not investment advice. Some people might really take risk and screw it up. I'm talking about my personal experience. I think I anchored a little bit too much on capital preservation and I didn't take enough risk. And once I took enough risk, I mean, in the case of crypto, obviously it's unique, but, capital preservation happened, plus you got returns, right? So I just think if you have a long-term time horizon and you understand what you're investing in, don't be too conservative. That's what I would tell myself of 15, 20 years back.
All right. What is your proudest accomplishment?
My daughters. I don't know if it's an accomplishment, but the proudest moment, I guess, for me, is having my 2 daughters.
Love it. Marcos, man, thank you so much. I appreciate this. This was stellar. If people want to find out, more about yourself or Accolade, where should they go?
AccoladePartners.com. Easy.
All right, Marcos, thank you. Appreciate it. We'll talk soon.
Thank you very much, Andrew. Take care, man.